the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. July was a blockbuster month for the Singapore Exchange. Trading liquidity jumped 44% from June to hit a 3-month high. Securities turnover rose 27% year-on-year, and activity in small and mid-cap stocks nearly doubled. Derivatives, ETFs, commodities, and FX futures also saw broad-based gains, from record iron ore volumes to surging currency futures. With the Straits Times Index also climbing to fresh highs, it's clear that investor confidence is running strong. But what's driving the surge, and is it sustainable? Well, to find out more, joining me now is Alvin Chow, who is the investment advisor at iFAST Global Markets and co-founder of Dr. Wealth. Alvin, welcome to the show.
Hi, thanks for having me.
Thank you so much for joining us. Well, Alvin, July was a standout month for SGX, with total trading volume jumping 44% month-on-month to hit a 3-month high of around 39 billion units, and securities turnover up 27% year-on-year to 33.8 billion Sing dollars. What are the possible catalysts behind this surge in trading volume and liquidity across SGX in July?
I think there are mainly two reasons. So one is, of course, the stock market has been very bullish. The Straits Times Index is up almost 16% year to date. And typically when the market is bullish, you will draw in more investors who want to partake in the upside. So more volume begets more volume. And I think that is one of the reasons the market is having this momentum build up. And the other reason could be due to the announcement that was made earlier this year by the Monetary Authority of Singapore, right, to rejuvenate the Singapore stock market. And they have announced the Equity Market Development Program, or EQDP in short, allocating $5 billion to the local stock market. So that could also be one of the reasons why it's feeling the demand for local stock.
Well, this all comes after SGX introduced measures earlier in the year aiming to boost equities market vibrancy. How have those earlier initiatives, contributed materially, or have those earlier initiatives contributed materially to the July uptick?
I think one of the reasons is that because of this announcement, some investors may be front-running, right, because they are guessing which stock could benefit from the program, so they wanted to buy before the actual allocation actually takes effect. And in fact, out of the $5 billion, $1.1 billion has already been allocated to some of the asset managers. So I do think that part of that measures are trickling into the stock market already.
Okay. Taking a look at some of the details here, the liquidity in small and mid-cap stocks spiked 94% month-on-month to 261 million Sing dollars, far outpacing the broader market. So which factors do you think drove investor interest into small and mid-cap segments during July?
So the small and mid-cap indeed have rallied very strongly for the good part of the past 1 year, not just in July alone. And again, we talk about that. Good performance usually draw more investments, and I do think that is the reason why there's a spike in the trading volume among these small to mid caps. And besides the trading volume, besides the good performance, I do think that there are fundamental reasons as well. Because if you look at some of the earnings, the recent ones, just a few days ago, we saw Propnex, Apex Realty, both property agencies, report earnings more than 100% growth from a year ago, right? And even like pawnbroking firms, MoneyMax, ValueMax, have announced earnings growth of 79% and 35% respectively. So all these are very good results to show that there is real fundamental reasons why some of these mid-cap and small caps are running.
Okay. Well, in fact, institutional buyers net purchased 62 million Sing dollars in small and mid-caps for the 6th consecutive month. What does this trend tell us about the composition of trading activity?
So there are fundamental reasons could be one of the reasons why Insti are allocating more investments into Singapore stocks, because Singapore stocks remain undervalued and earnings outlook has been improving, right? We see the earnings results coming out and they're very encouraging. And as opposed to the higher valuation as in the US stocks now, right? So there could be some rotation on this capital allocation to more undervalued markets like Singapore, right? And second is the EQDP that we talked about just now. So Insti are encouraged to buy local stocks in order to get allocation on MAS. And once they get allocation on MAS, they are again likely to buy even more local stocks for the allocation of the deployment to take place.
Okay. Well, SGX also saw a notable 27% year-on-year rise in securities turnover, while derivatives volumes rose 25% year-on-year to about 29.3 million contracts. So, Alvin, how do you interpret the relative growth rates between cash versus derivatives markets? Does this signal a shift in investors' strategy?
I think the target audience between the cash and derivative markets are very different, right? So for the cash market, it could be institutions or the retail investors, while the derivatives market is mainly driven by the institution. And even among the institution, the participants are different, right? So for the cash market, it's likely bought and sold by unit trusts, ETFs, those kind of more traditional asset managers, while derivatives are usually traded by hedge funds, proprietary trading firms, or even commodity trading houses. So there are two different segments of the market, and the derivative segment has been a steady grower in SGX portfolio for many years, and that is one area that managed to develop into a very well-grown portfolio, right, and become a very popular place for these derivatives to trade in Asian hours. And some of the popular products could be the equity indices, right, like FTSE China A50, FTSE Taiwan, the Nifty indices. So some of these are traded by the institution. So I do think that this is one area that SGX has developed well over the years.
Well, meanwhile, ETFs under SGX's ETF link saw AUM grow 36% year-on-year to 14.9 billion Sing dollars, with STI tracking ETFs exceeding 3 billion Sing dollars combined. So what's propelling the rapid growth in ETF AUM? Are investors favoring passive instruments for exposure to Singapore's equities?
Indeed, investors are more educated about ETFs today, and hence they are more willing to invest in them as compared to unit trusts, because they're more convenient to buy and sell, just like how one will buy and sell a stock. And in this bullish market, instead of picking stocks, an investor can just buy, say, a STI ETF to gain exposure to the broad rising stock market rather than individual stocks.
Okay. And commodities volumes also surged 76% year-on-year, including a record in iron ore contracts, while the INR USD FX futures climbed 41% year-on-year. How would you explain the surge across commodities and FX derivatives as well? Could this reflect broader macro views such as supply chain pressures or global trade tensions?
I do agree that it's possibly linked to the macro reasons such as trade tariffs. For example, we know that the US has raised tariffs against a lot of countries, and especially harsh against India in recent weeks. So this could be a case where traders are increasingly looking to hedge Indian rupee against the US dollar, right? That could drive some of the derivative demands.
All right. And across segments, cash, equities, derivatives, ETFs, commodities, there was broad-based growth seemingly underpinned by investor confidence. How much of July's activity then can be attributed to broader macroeconomic sentiment versus localized developments?
I do think that the macro has a bigger impact than localized development. There is this rotation to international markets as US stock valuation became stretched, which we discussed earlier. And this also has really helped buoy the rest of the world stock market, including Singapore. And another macro aspect would be the economic growth. Right? It has remained resilient despite the trade tariffs that's been in place. But even Singapore economy grew 4.4% in quarter two, which is a positive surprise, and that results in an upgrade of this year's projection of GDP growth to 1.5 to 2.5%. So all these are good macro outlook, and of course the local development of the MAS policies, the EQDP, does play a part in rejuvenating the stock market as well. I do believe overall the Singapore stock market should continue to perform well, right? Although there could be some pullbacks along the way.
Right. Well, overall, Alvin, do you anticipate these elevated levels to persist through Q3 and into Q4 as well?
Yes, I do think so, because from my perspective, the Singapore stocks aren't expensive. If we look at the Straits Times Index, P ratio is about 13.5 times, where the 10-year average is about 15 times. So there's still some room to go, and I do think that there's still value to be found in Singapore stock market. And if this trend of rotation to value continue goes on, I do think that the Singapore stock market does look positive going into even Q3 and Q4, although there could be some hiccups along the way, right? Because stocks don't go up in one straight line.
Right.
But I do think that the general trend should be positive.
All right. Well, thank you so much, Alvin, for your time and your insights today.
Thanks for having me.
Thank you. That was Alvin Chow, investment advisor at iFAST Global Markets and co-founder of Dr. Wealth. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.